What the heck just happened to the stock of Paychex, the second largest payroll processor in America, focused on small and medium-sized businesses, as well as being an outsourced provider of human resources and benefits? Here's a stock that's moving steadily higher all year. But then after Paychex reported this morning, the stock got taken to the woodshed, falling nearly $3 or 4.6% today. So why did it get hit? Was the quarter a disappointment? Nope. Paychex delivered a 3-cent earnings beat off a 57-cent basis, higher than expected revenue, up 8.6% year over year. I like that. Those are good numbers. The problem here ostensibly was with the guidance. Paychex slightly lowered the forecast for the 2017 fiscal year, and investors always care more about the guidance, about the future, than the actual results, because I always tell you, doesn't matter what happened, it's about what's going to happen. However, there are some reasons to think the guidance cut isn't nearly as bad as it looks. According to management, they're cutting numbers mostly because of a change in accounting policies for certain tax issues. On the other hand, they also said their payroll service revenue growth, it's the main business, would come in somewhere between 3 to 4%. That's down from a forecast of just 4% last quarter. Not just a tax issue. We got to drill down. So should we be concerned about a softening Paychex business here, or are we getting a rare buying opportunity here in a stock that's been working its way higher for quite some time? And by the way, sports a 3.2% yield at these levels. Let's take a closer look with Marty Musi. He's the president and CEO of Paychex. Find out more about the quarter and his company's prospects. Mr. Musi, welcome back to Mad Money.
Thanks, Jim. Good to be here.
Well, Marty, we got to go right there because it is highly unusual for me to hear you do anything other than keep guidance, maybe even raise guidance a little. I'm just quoting from the conference call. You said events for the full year of fiscal year 17 as follows. Service revenue growth is anticipated to be in the range of 3 to 4%. And if you recall, this is a change. We had said 4%. And from our perspective, it's fine-tuning. From my perspective, I would have thought it might actually have gone up, given the fact that employment rates have gone down. So explain to me why I should think that Paychex didn't lose business to others.
Well, I think it is really fine-tuning. You know, we had a guidance out there at about 4%, approximately 4%. And when you look at the year, we lost one payroll day this year compared to last year, the way it falls. And we refined that. We refined it to be 3 to 4%. And we're always, you know, we try to be on the conservative side of making sure there's no surprises, and we're very transparent. So we went with a little bit of fine-tuning there. I think that was a little overreaction. The stock is up 25% since last year, even where it is today. So we're pleased with that. And by the way, the net income, there was some confusion on the call. The net income guidance didn't change. We just reported it on a GAAP basis versus non-GAAP. So we're still expecting net income, when you remove the discrete tax items from both quarters, to be around 8% growth, which we think is solid, and certainly it was a solid financial quarter.
No, it's definitely a solid financial quarter, but you mentioned that the fine-tuning about the day. I mean, you obviously knew when you made your guidance that there was a difference in the number of days. Why does it suddenly play a role this time?
Yeah, I think we look a little closer at it, and it you know, we have some thought there that maybe, you know, we're not as close to 4, that we're somewhere in that range, and so we decided to put more of a range around it. I don't think there's been any big surprises at all in the first quarter to us. Again, it was a solid financial performance. Sales were up in reps. We're fully staffed. Our turnover is at its lowest point it's been. So, you know, maybe just a little bit of an overreaction to us being a little bit more cautious.
There were several questions on the call about the competitive environment, whether it's got tougher, to try to isolate whether that, again, was the shaded in guidance. You reiterated several times that it is not more competitive right now, that it's pretty much business as usual.
Right. That's exactly right. We feel very strong about the products that we've been putting out, and we just had additional time and attendance products to handle the overtime new rules coming in December 1st. We feel very good about the product set. The service continues to be at record highs. So we feel very good about the competitive environment and about our ability to produce. So I think we'll be fine. You know?
Right. Because that's something I know I'm facing in some of the things that I'm involved in. The Labor Department final overtime rules become effective December 1. It's going to expand overtime to millions of workers. How will an employer know what to do?
Well, basically, the most important thing they've got to do is be sure they track that time. I mean, you're talking about employees that typically made $23,000 or less. Now it moves up to about a little over $47,000. As you said, that's impacting millions of employees. And so these companies that have not necessarily tracked time or been as careful, they really want to have a time and attendance solution where they're tracking time and making sure that they're managing their time and being sure that overtime hours aren't racking up for their employees that they didn't think about in the past.
Now, I think not everybody's a small and medium-sized business who watches. I know it because I use Paychex. If you can explain to people what happens, typically the government comes in, and if they think you're doing it yourself, they're suspicious. If they think you have an outside company doing it, they're far more willing to think that you're doing it right. Isn't that why a lot of people use Paychex?
Yeah, absolutely. I mean, they know, look, well, this is our 45th year in business, and we've been in time and attendance for over 5 years, and we have thousands, tens of thousands of clients on time and attendance. So they're going to know that, hey, I'm expecting that the products and the software and the technology that we're using to track time and report time and pay the right wage for that overtime is going to be correct. If you don't have anyone, they're probably a little more likely to go in and do some compliance audits or, possibly enforce some penalties on you.
All right, last question. Any areas of the country surprisingly stronger? I know that we've seen state of Washington be good. I know we've seen some of the Midwest not be so good. Where are we right now?
Yeah, right now, the East, it's a tale of two coasts.
Okay.
The East Coast has been coming on stronger, particularly the Southeast. I think home building is back up. Prices are coming back up on some of the more expensive homes, so you're seeing construction build up. The West Coast kind of saw their growth early, Jim, and so that's coming down a little bit and flattening out some. And the middle of the country, still in the more negative range because of energy jobs and fracking and so forth. And manufacturing, still not strong, of course, because of the strong dollar. So we're hoping things will, it's been positive growth in jobs, but slower. And we'll have to hope that the election doesn't have much of an impact on that. Hopefully it'll pick up.
Well, that's my thinking, too. That's Marty Musi. He's the president and CEO of Paychex. Always good to see you, sir. Thank you so much. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.